Really, what you got to do is sort of keep in touch with what local council's doing, development applications, mixed use transformation, and you can start to work out, well, is this area going through a moment in time where it needs to re-emerge? Does it have anything that can make it re-emerge, or is it just going to fall into decline? Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going to dig into really what I think is the number one rule when it comes to real estate investment, which is not supply and demand. Yes, that may come as a shock. We're going to dig into the principle of progression versus regression. Yes. There's one thing you want to know about real estate. This is it. So welcome back, regulars. You know the drill. Play the program in double speed. Get your life back. And, of course, all the episodes I've done are lessons on real estate. So feel free to check out some past podcasts. You never know what's going on in past podcasts. You can go back in time and learn some techniques around real estate. But hey, I've progressed. Yes, I took my wife out last night and she got to see a show and she's very happy. That is progression. That is the man-woman progression system. And we all want to progress. We all want to have a better life. We all want to end up in a better place. We don't want to regress, which is obviously to go downhill, to go backwards, to fall apart. No one wants regression. We all want progression. But real estate markets are shaped by both those words, progression and regression. And today I really wanted to go through the two of them to really kind of make sure that, we're across what an economic model is around momentum. Really, I teach a model known as momentum theory, the idea that if we can identify progressing areas, progressing streets, and avoid those which are going through regression, we can end up in a place where life is good. Life is good because there are plenty of places in society where real estate has a good yield, real estate is seemingly affordable. You can buy a decent sized block of land. You can get yourself an established property, which you could potentially, down the track could, do something to. But the properties are in regressive areas. Yes, they can be in places where gopniks hang out, where you literally get off a train station and you see someone in a ski mask whacking someone else with a golf club. So we don't really want our investments in areas where the community is wearing ski masks and hitting each other with golf clubs. We want progression, not regression. And of course, really when it comes to the concept of progression, it's all about capital flows. Where is money flowing? Remember, where money flows, real estate grows. And of course, when it comes to capital flow, there are 5 important capital concepts. And I've spoken about them before, and I'm harping on them about them at the moment because I think you start to find wealth, and wealth is really a trend as opposed to just relying on market cycles. But capital flows, like material capital flow, where are new buildings being built? Where is activity being created? Where are new train lines? Capital flows determined really whether an area is in growth or in decline. And if you've ever been to a third world country, you probably understand what I'm talking about. just basic infrastructure at a localized level is not there. And so you get this very repressed economy. And that can happen here in Australia. There are plenty of suburbs which lack basic amenities, which lack basic public transport, which lack basic social cohesion, which lack all sorts of problems, that they're just not winning the race when it comes to progression. And of course, if you buy in those areas, you're going to suffer a pretty low rate of growth. So the momentum principle is we want progressing suburbs that attract good people and good capital. The polar opposite can be said for regressing places. They are areas which lose capital and lose people. They lose demand. More people that want to come to your area, you gain demand. The more people that want to leave an area, you lose demand. And of course, this creates a self-reinforcing cycle. If we can get in the right places which are progressing, we can do very, very well from a real estate perspective. And again, like if you think of a growth loop, it is like infrastructure investments increase access, demand rises from owner-occupiers, demand rises from renters, capital reinvests in housing and business, high incomes move to an area, prices and rents grow. It's like a progression loop. And if you think about some of the most challenging places here in Australia today, they don't have a lot of demand. They're full of renters, not owner-occupiers. Capital's not reinvested at a local level. The local shops are nothing special. There's a lot of for lease signs in the local retail strip. The local retail strip doesn't get reinvestment from the local citizens because they don't have spare capital to go out for dinner. And so you get this kind of spiral or doom loop, if you like, of real estate. And the reason, I want to sort of bring it up, I mean, I see a lot of buyers agents sort of advocate what they are working on, certainly younger ones anyway. And a lot of them, I would say, are in regressive neighborhoods. The prices look good on paper, the rents look good on paper, the land looks good on paper. But when you buy real estate, you're not just buying the yield, you're not just buying the land, you're buying the neighborhood, you're buying what is going on around you. And again, like if no one's renovating in the local area, if there's no new businesses opening, if council's not revitalizing the local neighborhood, if there's no major government investment, if there's no infrastructure unfolding in the neighborhood that is set aside through Infrastructure Australia, then there's no capital inflow. So a marketplace will either stagnate or it will regress. It will regress. And a lot of, I guess, people who come from, countries which are less well managed kind of understand this concept, because a lot of their cities today have regressed to the point where the public infrastructure is very, very run down. The train stations are run down, the fountains are run down, the streets don't get repaired on time, the potholes don't get fixed. And so you get this kind of regressive kind of economics where it's very hard for real estate to go up in value if the neighborhood's in rapid decline. And of course, what we're looking for progression is, for one, stability. We want good streets, good amenities, good air quality, good community spirit, decent schools. All of those things are a stability indicator. And, when it comes to progression, if we can find things that tend to create stability, it's a good foundation for future progression. Wage growth, industry, broad-based industries, and of course, local economic expansion. And, it can be in blue ribbon suburbs that there's local economic expansion. It can be in emerging suburbs where there's local economic expansion. Sometimes in real estate, there's a big focus on supply versus demand. Really, the context of supply versus demand, I think, needs to be also highlighted versus the idea of progression versus regression, because you can have an area which is going to have supply over the next 5 years put into it, but is that regressing or progressing? Is the idea of new neighborhoods progressive or regressive? And I would argue it's quite progressive, particularly if it's done right, with right new schools, right new shops, and then all of a sudden you get this kind of progressive economy. And I've seen this sort of firsthand at my economic investments in, say, Newcastle. In Newcastle, you had very regressive kind of middle ring suburbs, which were kind of basically falling down. You go 5 minutes further down the road, you get sort of a brand new community effect, brand new schools, brand new Coles, brand new roads, brand new infrastructure. And you got a huge level of uplift in the progressive area and a stagnation effect in the regressive area. Because when you go through the regressive area, the houses are kind of old and past their use by date. They're sort of, fibro homes or weatherboard homes. And so if you thought about Newcastle, there's a bit of a renaissance now in those middle ring areas, but it wasn't until some of the newer properties came to create progression that actually helped those middle ring suburbs go through a bit of a renaissance. And so it's very, very important that you think about where you're investing and just ask yourself a couple of questions. Is this an emerging suburb? If it's emerging, it's going to be pretty progressive. Is it an accelerating neighborhood? It can be pretty progressive. Is it established neighborhood, which is getting circular capital flow, lots of money reinvested into it? It's always improving. A good example of a circular neighborhood that's quite established is Manly, and I talk about it because, I live in the Northern Beaches, but Manly's very, very progressive and it's very established. It's just, local businesses, local entrepreneurs are spending huge amounts of money opening, new bars and new eateries, and the councils, allowing new ways to hang out longer into the evening, and providing new solutions for parking and all sorts of things. It's very, very progressive for an established place. And when you progress, you see real estate growth. When you stagnate or decline, you see real estate fall. And it's not really until the market really goes through a bit of a touch up that you start to see this happen, because, right now, I guess you could say in most marketplaces, the stability around real estate is very, very high. And so, the weaker end of the market, the areas which are regressive, they're not going down in value right now, but they will go down in value because they have no progression to those neighborhoods. And it's not until you start to sort of see, a market, go through a lull that you see regression at work. And one could argue, certainly pockets of Melbourne which have gone through a market low, like Melbourne's probably the counter cycle to the rest of Australia, where it's sort of gone through its 5 years of just, not great growth. It's stagnated. And as it's economically stagnated, some suburbs have fallen into decline. and they're not progressive neighborhoods. They're not progressing whatsoever, and they've got a long way to go to catch up, because the shops are closed, the businesses are fragmented, the druggies have moved in. You could probably look at a place like, Chapel Street and particularly into Commercial Road down in Melbourne. It needs a new system down there, and definitely at a local council level and a developer level, developers have recognized this, and I would say the renaissance of that area is going to be unfolding over the next sort of 5 years, but it's definitely stagnated and it's definitely fallen into decline. And that has had a softening effect on property values in that precinct. And so you can research whether an area is going to go through decline and then come back to a sort of urban transformation effect. And really what you got to do is sort of keep in touch with what local council's doing, development applications, mixed use transformation, and you can start to work out, well, is this area going through a moment in time where it needs to re-emerge? Does it have anything that can make it re-emerge, or is it just going to fall into decline? And certainly when I analyze some of the suburbs that are out there at the moment that are affordable, they're very affordable, they're not expensive. You can get land, you can get an established home, but they're very stagnating places. Like there's not a lot of development applications coming through the system in a lot of these areas that inspire progression. They are just properties in a regressive marketplace. So momentum can kind of be measured. It's capital, which is development, which is not just about supply. It's about business development. It's about infrastructure development. It's about development applications by private enterprise to bring life to an area. So capital plus demand plus stability equals growth. It's really the model of momentum. It's very measurable. And if you've got no capital coming to a market, the demand will be weaker. The stability will be a lot more up and down as cycles work, and growth will be a lot lower. If you've got high levels of capital, high levels of demand, and high levels of stability, guess what? You get high levels of growth. That's the economic model, momentum theory model. It's a model I work with. And again, like it's like MC squared. You find the capital, you'll find the demand, you'll find the stability, you'll find the growth. Now, remember, like progression is in an economy, it's in demand, it's in a suburb, it's in a street. It's everywhere. And so is regression. When you're buying real estate, you're not buying the property in isolation. You're buying the property in the street, in the suburb, in the economy, and it's all wrapped together. And so you see this all the time. Like you can have properties in the street where your neighbors are owner-occupiers that are just spending so much money lifting the value of the street. And they're always putting development applications through. They're always doing knockdown rebuilds or renovations or extensions. This is a form of progression. Conversely, you can find streets where every house is basically going backwards. It's depreciating at a rapid rate because no one's prepared to spend any money on renovating their home because no one has any money to renovate their home. And as such, you just get an urban decay effect on the real estate, which again just softens the rate of growth. And, I'm going sort of through this where I live at the moment. It's like, wow, just when you think it's over, like, a home renovation, you think, wow, I can finally, not listen to builders, jackhammering stuff. A new development is created and, lo and behold, in your letterbox, your neighbor's doing a renovation. And whilst it's frustrating when you live next to this stuff, it's actually a blessing because economically it makes you money, the principle of progression. And again, this could be at a street level, suburb level, state level, city level. Progression is something that pushes values up. And again, if you ever go to a third world city, you see regression at work. And it happens here. It happens a lot in regional towns. They're very regressive places. They don't have the infrastructure spend. They don't have the money to, keep their city beautiful and attract talent. And you see this kind of regressive effect on those marketplaces. So progression lifts property values, regression suppresses property values. Properties are very contagious. If values in an area are improved because the area is improving, it will affect your real estate if you own real estate in that area. And often we refer to the worst house in the best street versus the best house in the worst street. And it's a good way to kind of understand it because you get this pull upward or downward. Now, if you've got the worst house, but everyone's renovating and everyone's improving the value of their real estate, it's going to lift the value of your real estate. That is progression. However, if you've got the best house and everyone's got a really, really bad home and no one else has the ability to renovate and every house is in urban decay or decline, even though you've got the best house, the neighborhood will drag the value of your house and your land down. That is the principle of regression. And so we want, for a better word, the worst house in the best street. Now, I always caveat that by saying, well, let's just get a good home in a good street where everyone else's house is, doing better than us because that'll lift the value of us. But let's caveat that by having a decent enough dwelling to get a good rental return and not spend the rest of our life fixing toilets. So a classic example of that is identifying a home, a single-story home, next to some big double-story, big boppers down the street or next door or wherever it may be. A lot of that is the principle of the superior house will drag up the land value on your real estate. So we don't want the best house on the worst street, that is for sure. We're looking for progression at a street level, renovations nearby, lots of development applications in council for extensions, knockdown rebuilds, all these kind of things. We want the owner-occupier effect of improving their homes, the Bunnings effect. Remember, your neighbor is your capital growth. Your neighbor's investment into their world lifts your real estate. And I always say this, there's kind of 4 ways to create capital growth, and they're a mixture of unearned growth and earned growth. Now, if you buy real estate and you put a strategy to the real estate as you buy it, develop or renovate or subdivide or build, you create earned growth. So you can earn growth doing a build on some land, or you can earn growth renovating. You can add value to real estate effectively. And that is through the productive means of you, the investor. But then there's the location. And the location for most investors is out of area. They don't live there. So they don't provide any localized effort to make the community better. They don't go to council meetings. The investor typically isn't involved in the local school board or the local scouts or, the AFL club or the local bowling club. They really have nothing to do whatsoever with the community itself. And, from a progressive point of view, we actually want neighborhoods where there is a decent amount of owner-occupiers, because the owner-occupiers will care for the community. And if we end up with a high tenant turnover neighborhood, or the broken end of town where people go to rent because they can't afford anywhere else, but the property values in the area are very, very affordable for an investor and the yields are 5, 6, 7%, doesn't actually bode well for progression. You will see regression because no one's in the neighborhood giving no one cares about the neighborhood. You don't care and your tenant doesn't care. And effectively that becomes the biggest problem. You become the system doesn't work, and it only works. You only get location growth, which is unearned by the property investor, because it's the sweat equity of the local community, your neighbors renovating, your neighbors going to council meetings, your neighbors. And when I say your neighbors, your investment properties neighbors are putting the effort into the community, asking more of local government, asking more of state government, asking more of themselves, putting themselves in financial debt to make their real estate better. That is progression. Regression is the polar opposite to that. So if you think about progressive areas, they can be old places. Like take Paddington. 30 years ago, most houses in Paddington were in regression. What happened? Heritage restoration, lifestyle uplift. All of a sudden, the houses became very posh. The terraces transformed into premium assets. You had character, scarcity, location. You had progression. And then inside of that, you had businesses open, beautiful boutiques, all that kind of stuff. So you get progression. You could think of like Fitzroy, Melbourne. It started as an area of migration. It was a pretty dour place, 50 years ago. Gentrification, rising incomes, and you get progression. Now people are very brand associated to Fitzroy. Newstead, which is basically this brand new place, if you've ever thought of it, it's like a whole bunch of buildings clustered together. It was an old industrial area on the riverfront of Brisbane, and it attracted the most professional high-income demographic for Queensland. And today, through transformation of urban living, of beautiful buildings, of the best gym in Australia, Total Fusion, you get this kind of like progressive effect. It's a very progressive society. You go there, you'll have food you've never tried before. You'll have local businesses that make their own branded beer. You'll have the greatest wellness scene in probably Australia at the moment, which is around Long Island inside of Newstead through Total Fusion, which is just a gym, but it's pretty progressive. It's a progressive concept. And again, it's not a gym falling down in the back blocks of, the some dodgy suburb. It's got all the beautiful people like wearing all the latest equipment, latest clothing, progression. And so demographics, rising incomes, owner-occupier growth, and then you get this kind of like circular effect of better coffee shops, better bars, better, eateries, better massage therapies, better yoga studios. You get 5 yoga studios, you get Pilates studios, you get all sorts of stuff. It's all designed around progression. And again, like if you think about places which have regressed, I mean, you could go back to the mining towns, which, basically had an artificial influence of transient workers that sort of lived there. Because they came to town, prices went skyrocketed because there was more people than there were places, supply versus demand. But the principle that no one thought about was progression versus regression. What happens when they leave? Well, I'll tell you what happens when they leave. Boom went to bust and real estate values fell through the floor. They went down 75%. Again, whether a place has risk or it doesn't have risk is a big element around progression or regression. Now, good old Lismore, I hate putting the boot into you, but you flood every 5 years, and it would be very hard to progress in that area as a local business person. It would be very hard for new businesses to want to go to Lismore and open up because of the fear of flood. And so new businesses will probably bypass Lismore. And as such, you would imagine you would have an economic output effect of regression eventually. Maybe some diehard locals will stick it out, but attracting new people could be very, very difficult. Regression. And really what we're looking for is alignment, good street, good progressive suburb, good progressive city, good progressive economy, and that compounding effect of progression will eventually unfold. Now, you could say, like for example, in Melbourne, you can still find a great street, great suburb that is very progressive, but the economy is not progressive at the moment. Perhaps a shifting government will be the signal to progress that city once again. And then if you own real estate in a progressive street and a progressive suburb, all of a sudden you're going to get the compounding alignment of progression. So as an investor, it's pretty simple. Ask yourself, is this area improving or is it actually in decline? If it's improving faster than the rest of the market, it's on a good trajectory. And again, like if you look at areas which are set aside as state government fast-track areas, like they're designed to get a lot of growth very, very quickly, quite often they're new sectors in our area, in our cities. You can look at the growth of, for example, Schofields or Tullawong in Sydney. I mean, the growth's been exponential, but the government said, this is where we're going to grow. This is where we're going to ask society to urbanize. And through sector urbanization, you end up in a place where there's high growth because of progression. You can't say to me that an area which is going to get billions of dollars of investment from new train line to new supermarkets to new schools to new roads to future even rail links to a new airport is not a progressive community. That is the total it's totally progressive. And then you look at the growth rates. They're very, very high. They're very, very high. Is it a blue chip suburb? No, it's not. But it's a progressive suburb, and that's the main thing we're looking for. As opposed to areas which just get left out. And there are plenty of suburbs in Sydney, Melbourne, Brisbane, Adelaide, Perth, wherever it may be, that just get left out. They're just not on the radar. They add no economic output to the town plan of the city, so they just get left out. And they can look affordable, and they can even be in, proximity locations not too far away from the city, but they're just not progressive. They're regressive. And so we don't want property regression if we can afford to find progression. So again, if you look at Australia's aging population, you're going to find regressive communities. I mean, Australia is aging too quickly, and you start to get these kind of areas where only old people live, particularly in regional areas down the coast. You know, I was just down in Eden, and, you know, geez, man, like, it's not a lot going on. Not a lot going on. And again, like, beautiful pocket, it's like pretty and stuff, but it's just a regressed community with no entrepreneurial flair because it's actually quite aging. You know, the average age down there is pretty old. And so you've just got to sort of weigh it all up. I mean, what we're really looking for is young people moving out and old people moving in. That in itself is regression, because we're actually going to end up having real estate in a pensioner economy as opposed to a emerging economy. And again, like, not to pick on old people, but, you know, they don't really need to spend money. They've spent money through their years, and they're just looking for somewhere quiet to go and regress, age. As a polar opposite to, you know, a young entrepreneur that wants to own a Pilates studio in a, you know, half decent pocket and puts their own money behind it. And if they fail or succeed, they're trying to progress. Really, that's the economic fragility of it all. If we follow regression, it's fragile. And, you know what? You don't just buy a property. I mean, I always say this, you don't just buy a property, you buy it all. You buy the economy, the supply pipeline, the demographic future, the risk profile. You buy the street, you buy the suburb, you buy the neighbors. That it's all encompassing. And again, we just want to follow progression, and we're going to do pretty well out of real estate. Is it the number one thing we should follow? I think it is. I'm going to go out there. I'm going to put myself on a limb and say, what is the number one rule of real estate? It's not supply and demand. You can have an area which is getting supplied of real estate, but it's progressive. It's going to do well. Conversely, you can have an area which is completely undersupplied of new real estate, but it's got aging real estate and it's got nothing new happening for it. It can be very regressive. So probably the number one principle of real estate is to work out if an area is progressing or regressing, going backwards. All right, folks, that's it from me. Let's talk again down the track as we do another podcast. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn.
And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.